Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, February 12th, 2025. It is 10:15 a.m. Eastern Time. I wanted to do a relatively brief video, just get it out to you, give you my thoughts. We'll stick to the equity markets on this one, and interest rates, bonds. That's very, very, very much related, more so than just about any point in time. Other than the last few years, obviously, for 30, 40 years, it didn't even matter really. We'd watch bonds. I'd always cover that. There was some, reactions to the market. But again, I've been stating we're still on the heels of the hottest inflationary environment in over in a half a century, over half a century. So, as such, the market remains hypersensitive to rates, and I've given you the easy for over a year now, the trade by colors kind of thing. I'll get to that in a second. My yellow, red, and green zones for TLT, the 10-year bond. But let's just start out with the stock market. I got that post out to you today, just kind of showing you in the last, this recent, since the top here, all the big corrections, 1, 2, 3, 4, 5, and I believe 6 now. We'll see, time will tell, have all had one common thread. Most had divergent highs, which I've highlighted there, but most kicked off with a bang, meaning a big red. You don't have to be an expert technician, chartist to see it. The big red drop that kind of does what I like to see when I'm long. I like to see that in reverse. I like to see a huge, big, fast green candle or a gap up. And then when I'm short and bearish, I like to see a big reversal stick to the downside, and it serves two purposes. As I said this morning, it traps longs. Nothing is better if you let them all out easy. Then you tend to get just mild corrections and dip buy or step in. So when you can trap longs and blow past their stops, remember I trade the futures primarily, but I do trade and I have various accounts. I use ETFs too. Most traders use an ETFs. Most individual traders, even a lot of institutional traders will use them, and a lot of institutional traders, more importantly, hedge funds, professional money managers, are trading stocks. Therefore, they're subject to the gaps because they start trading. There are pre and post market trades, but they're a real pain in the ass. You have to use limit orders. It's almost impossible in a fast moving market like this morning, for example, when the CPI data hit. You can't you can't move fast. If you have a limit order and it gets bypassed, that's how it works in pre-market. You can't put a stop loss order to trigger in pre-market. They're not allowed. A stop limit order is, but a stop limit order gets bypassed. If a stock is right here and your stop limit order is right there, and then it just moves right through that price, gaps beyond it, and keeps going down, your order's still sitting there and you're losing. Stop loss orders only can occur during market hours. So that happens. And so what I was getting at, it tends to trap those longs, and also the quick move denies what I call waffling shorts. You know me, I'm very contrarian. I'm usually buying when very few want to buy and everyone wants to sell or get short. And I'm usually shorting or highlighting objective short entries when everyone wants to buy because the market feels bullish because it's going up. Like the last three shorting ops I highlighted were here, here, and here. We had them all here, these divergent highs. So we'll see where this goes, but let me go over kind of a quick recap on interest rates and where we're at and what to watch and how to trade it. So there it is. And of course, we hit that. These are the same levels that you've had on the chart. This morning, I wanted to fire that post off. It went without saying. We were at support, that 21,537 right there. And then the same chart I gave you on ES the other day, same level we bounced the other day. I have supported about 60.16, 60.17. And as I said, that needs to go, and then that opens the door to the next one. So this is reflexive buying, but there you still have that impulsive leg down. And let me now show you where, what can help be your guide whether to go long, go short, go aggressive short, and that is interest rates. So we're going to toggle over to, if you saw yesterday's video, I don't know if anybody watched it and no comments on it, but predicted a hot CPI for the reasons I'm going to show you, and that's what happened. And you can see what happened to the futures as they plunged this morning, straight down drop. The consensus was an increase of 0.3%, came in quite a bit hotter year over year, 2.9, and came in hotter there, and so the market dropped down. So in yesterday's video, the reason for that was this. It was twofold. It was, number one, this, and again, watch the video. I go into all the little nuances of all this, but this is the January commodity index, GJP, the one I've been using for over a year now to predict, whether the CPI will come in on track, above or below. And again, this was. It was super clear. I mean, we had right out of the gates in January, and we remained elevated throughout most of the month in the upper half of the range. And then more so, like I addressed, a lot of this, there's a lag time on many things. Oil is closer to more of the immediate effect, and it is one of the biggest components of the consumer price index. Food certainly in there, and it has a good weighting, but again, as I stated, they are not pricing in a barrel of a bushel of wheat. They're looking at a loaf of bread. And so I also pointed out, it takes this trend we've been walking up, commodity prices as a whole, and I'll just use that example, but you look at orange juice prices have gone through the roof, parabolic, like never seen before. Cocoa, is it going to move the cocoa going to move the needle? No, but it does have an impact on obviously quite a few companies out there. And again, the coffee certainly does. And these things add up. That's my point. What else do we have going crazy? Cocoa, coffee. We all know eggs, of course, what's going on there. And it's translating over to milk and other things like that. And so, initially people dismiss these things as a one-off. But you get enough one-offs, it starts to add up and make a trend. And again, that starts to become inflationary. And it will, despite pricing pressures, kick back. We all heard about, the consumers were able to swallow that inflation pill after COVID because everybody was flush. The government was cramming money down your throat, whether you wanted it or needed it or not. You got to check. You had a business, it didn't matter if you're having your best year ever. Most people I knew down here were. And we still got, tens of thousands, in some cases, I know a lot of people, hundreds of thousands of dollars crammed down their throat. Hey, take it. You qualify for it. So that was PPP I'm talking about, of course. And then all the other stimulative measures. So anywho, my point is consumers were okay and swallowed that pill and then recently started to push back. But there's only so much before these higher prices percolate again into the next leg up in inflation. And let's not even get me started on insurance, what that has done. The global warming deniers really they don't have a leg to stand on anymore. We've seen what's happened in the last few years with unusual hurricanes, flooding, the fires, LA burning down, and you think that, that's going to help. I believe that's the biggest metropolis in the country, if I'm not mistaken. I thought I heard, and that's certainly not going to help housing prices over there, which may move the needle nationally. Anyway, I can go on and on and on. So let's just follow this. Let's just keep track on this. Note that at this again, I use this because it's not perfect, but it's about the closest thing to a real-time inflation indicator. And look what we just did here. We just popped. We've just made a new high now, and so you pretty much had these, all the makings of a new uptrend. In other words, commodities are breaking out. So I'm going to talk on that a little bit here. So, all right. So again, 1 month doesn't make a trend, but we had another, hotter than expected CPI report. Market reacted, and so now let's talk on, trading strategies and all that. Okay, so what does higher than expected inflation do? It raises interest rates. Did it make Powell cut or raise the federal funds rate? No, of course not. He made it clear yesterday. He has no tension right now. He's sitting tight. He thinks everything's hunky-dory. But what it does, it raises the interest rates that matter to you and I. Not a single person or have ever met unless you know a CEO of J.P. Morgan Chase, Jamie Dimon, any of the major bank CEOs. You don't know anybody that borrows from the federal funds rate, the rate the Fed set. And Powell even said it yesterday. I've been saying this for years. He has absolutely no control over interest rates in the economy, long-term rates. He sets a rate which banks borrow an overnight lending rate. You and I don't have access to the federal funds rate. Never have, never will. Doesn't matter to us. It's almost, and it used to be relevant because in normal times, before the government gone wild with this massive grand experiment ever since the financial crisis, deciding to just keep rates on the floor near zero and keep the pedal to the metal with stimulative excessive easy money. It's all coming home to roost now. So back what I'm getting at, it used to matter what the Fed funds rate did because in a normal environment, when the Fed cut or lowered rates, the bond market reacted. The 5-year bond, 10-year bond, 30-year bond, mortgage rates reacted. So the Fed, indirectly, but fairly effectively, did have control, or at least to a good extent, on rates. A few periods of brief, check. But right now, the bond vigilantes have checked the Fed. The Fed, as I said months back, the Fed has 110% lost control at the long end of the curve. They do not control it. Market forces are controlling it. So we saw that when with the rate cuts the Fed had last year. Every single time they cut long-term bond rates, instead of going down like many expected, they went the other way. So that's the reality of it. Okay, now how do we trade it? This is today. This is the TLT, the most important bond, the 10-year bond. And there's that bearish rising wedge right there. Remember, we were long here off the lows. We milked it up there, turned around, got out, hit my target. Well, we were trading the long bond, the 30-year. And then I told you when we hit the target long bond, I waited a little bit. We got a little higher, nailed the short entry there, and I covered yesterday. Told you to hit my target. And then somebody asked, okay, Randy, we hit the target. Does this mean rates are going to go up? I said, no. If you pay attention to the post I made, I quite often tell you I reverse when a target's hit, meaning I would have gone long, but I didn't because I said I didn't have confidence that rates, the bonds were going to bounce, and they certainly didn't. So sometimes I'm confident enough when my final targets are hit to reverse it, going short to long or long to short. But yesterday I made clear in that comment section that I didn't do that, and I also made clear it makes sense if you watch yesterday's video. I was expecting CPI to come in hot. Therefore, rates would go up. And so if anything, and I just gained it by the stock market being short, but would have been short Treasury bonds. But either way, they went down because rates went up. It's a pretty big gap. But more importantly, where I'm going here, guys, look what we did. So we're back into my orange zone. I'm going to toggle over to this 2-hour chart. This has just really allowed us to navigate the markets with and I know I speak to active trading, swing trading. Now I'm speaking to swing trading, okay? Swing trading. And I'm doing this video, did a video yesterday because I'm starting to see opportunities present where we may be ready to exit that trading range we've been in for a while now. And it may be time, I believe, to morph from more of an active trading style to a swing trading style. So these are the zones I laid in back in the beginning of 2024. I know this is a busy chart. I'm just going to highlight it for you here. This is my green zone, yellow zone. I know if you followed me, you've heard these for many, many times. I've covered this dozens and dozens of times. So yellow, orange right here, red zone. And the green zone, net bullish for the stock market. Yellow zone, stock market starts to take note of rising yields. Orange zone, the stock market really, in caps, really starts to take note of rising yields. And then down here, red zone, market freak out. We haven't entered the red zone yet, but God forbid, God help us. Well, I think I would embrace it. I'm looking forward to it. I think we'll get there. And that'll just be a great time to be shorting everything with a ticker, just about, especially risk-on stuff, tech stocks, the NASDAQ 100, Bitcoin, stuff like that. Okay, so let's just examine what's happened. So and bear with me, guys. I don't have a way to make this any cleaner without replicating the whole chart. I know it's busy, meaning a lot of things on there, but you can see in blue right here. This blue line is the NASDAQ 100. Okay, the candlesticks are IEF. So what I'm going to do, we're going to focus because the orange zone is, again, where it's actionable, timing wise to trade long or short the market. So we're looking at my preferred market proxy, NASDAQ 100 in blue. And so back here, right here, and this was in April, early April of 2024, we entered my orange zone long before in advance of laying it out. And you can see, I think you can see, if you can't, the NASDAQ was in an uptrend. This is the NASDAQ 100 going up, up, up to right here, corrected. And that was a good correction. It's high single digits, maybe even double digits. Biggest correction that we had in months, if not maybe even a year. And that was because we entered my zone there. Then you can see, and again, the case was made, and we would have done it at the time, I believe, went long treasuries. I expected a pullback in rates. There was positive divergence. So the 10-year rallied, and then the stock market picked back up. But then we turned around, we dipped back into the orange zone, another correction. Okay, bonds continue to rally. We got out, we got back into the green zone. All good on the stock market, right? New highs. But then look, we went down, dipped once again, and I remember warning of it at the time. Boom. The market was getting tired of this dipping into this orange zone, and that was the biggest correction. Again, that one was even bigger than the previous one by far. That was the nice correction into the August 5th lows, which at the time we milked that thing down with impunity to the shorts, cover the morning of. It's on the site, pre-market, hard cover all shorts, go hard long, expecting a bounce, and the market bottomed literally in pre-market that day, and then set up the biggest rally from there, or the rally into the highs. So everything was hunky-dory. Here's where I'm going. So this is, remember, the candlesticks here, green zone. This was all green right here. We were in the green zone. No pressure for the stock market, because that meant, remember guys, when the bonds are going up and the 10 years up and in the green zone or rising, yields or interest rates are falling. So we come full circle back here. We entered that yellow zone and then dipped into the orange zone. Remember, that was just a yellow zone. Stock market would start to take note of it, and it slowed the ascent down. But this is where we entered the orange zone again. Right here, and you can see perfectly. Let me zoom in for you here. This is where we entered my orange zone right there, and boom, there was a top in the stock market, the NASDAQ 100, the market I'm trading, and that is still the top. And we remained, and we kept going lower, lower, lower into the orange zone. But right about here, that's also the last time we went long equities. Remember, reversing there, going long for a bounce based on the stock market charts, but this too. And we were long treasuries, and that was that recent bounce. You can see treasuries bottom right there, the 10-year bond, the most important one. We broke out of the bullish falling wedge. We had this rally we just had. The stock market liked it because we got back out briefly got into the yellow zone, but then boom. Here's my point. So where are we going now? Again, this isn't the be all end all, but it's done a damn good job of kind of, hey, heads up, this is what's going on. And so far I haven't had to modify. Early on I tweaked the zones, one of them ever so slightly. I just made an adjustment. These are based on mostly support and resistance levels on the treasury bonds and yields. But so my point is, here we are today. We tried, and the market was rallying, and we caught that rally, every penny of it. Then we turned around and shorted it there, or at least that's what I told you I was doing the other day. And now we're back into the zone. So this is my point. We are back now into the orange zone, and so unless we exit the orange zone, which is right here, 93.40, give or take. You want to see that recent high get taken out. That's net bearish, and as such, that tells me, puts me into short rallies into resistance mode. In other words, bulls buy the dip, and bears in a bear trend sell the rip. You sell the rips, any rallies into resistance and or breaks of support. And of course, I've given you the levels on the futures. I think QQQ. If you need a updated QQQ or SPY or IWM chart, let me know. But this is it. So I just wanted to point out that, and you can see this is not mere coincidence. So the takeaway is I marry together my analysis of Treasury bonds because now, so at least in the last couple of years, more so than any other point in time in decades, it matters, and it matters a lot. And it doesn't matter when you're up here in the green zone. You can have a pullback in yields or up or down. It's in this orange zone again, as the annotations here say. It stock market really starts to take note, and then this is it. The stock market will freak out if we get there. So now let's just change gears a little bit and talk about that. So this is kind of bigger picture. And we're still not to that all-in heavy, aggressive short moment because I have too many of the Mag 7 stocks, as I told you, still above their 200-day moving averages. If and when that changes, then that's where kind of press turn into trend, swing trading mode, push the shorts hard, short rallies into resistance, any counter trend rallies. We're not there yet, but let's look at this. So TNX. This is the yield on the 10-year Treasury bond. Again, the one the market puts the highest weighting on. This is what your 30-year mortgages are tracked to, believe it or not the 30-year bond. They track closer to that 10-year bond. And so this is the one Wall Street watches. And they do watch the long bond too, don't get me wrong. The long bond, the 30-year is important. But again, this is a recap for those kind of maybe new to the site. We were in a secular bull trend on interest rates, rising rates throughout which peaked in the early 80s right here. Think Carter going out of office, Reagan coming in, runaway inflation. That's that period that they talk about if you weren't around back then, where last time we had that kind of very high inflationary environment, and the stock market was in one of the worst bear markets from the late 60s throughout the mid 70s because of it. And then things changed there. That marked an end of what we call a secular bull market in rates, meaning rising at the bigger trend. And we started a new secular bear market in interest rates. Seculars are your bigger trends. And within a secular bull bear market, you have cyclical bull and bears. And that's what these trends. Remember, these are multi-year. We're looking at a chart here going back, well over a half century. So, and you zoom in, and I've made the case many times over that this was just a complete textbook selling climax. That's when the Fed hit the nuclear button. This is when COVID started. The financial crisis back in '08. And these are your bouts of quantitative easing, excessive, artificial manipulation, excessive of interest rates to bring rates down to zero. This was a natural market forces, just an abatement or a bearish trend in rates, falling rates, which of course gave us fuel for one of the best stock markets in history, because the stock market likes falling rates for many reasons, obviously. Many I've covered in the past. But then you had the bouts of quantitative easing, and then they just smacked down, hit the nuclear nuclear option when COVID hit. Government overreacted, everyone freaked out. So it's not just what the Fed did, what Washington did. And so that ended, and it ended with what we call a textbook selling climax. We shot up, and then by every technical metric out there, including the primary downtrend line being taken out, previous reaction highs being taken out, I've made the case that this will go down in history most likely as the end of the secular bear market in rates, and the beginning of a new secular bull market in rates, meaning rising rates. Okay, so only time will tell. And again, years from now, we can look back and we'll see. I can tell you with confidence that even if I'm wrong, there's nowhere else for them to go down. So worst case scenario, we just sit here flat for a while. We come back down to near zero. But that's unlikely, in my opinion. So where are we going to go from here? I've laid out for many months now, if not a year or more, that bonds have just been so tradable. I would have never thought, 10, 15 years ago, if you look at, back in the last year or so, I've made good money trading bonds. I'm not a bond trader. I don't put any label. I'm not a commodities trader. I'm not a stock market trader. I'm not an individual. I trade whatever's there. You give it, if it has a ticker and I can chart it, be it Bitcoin, crypto. I may not believe in those things fundamentally, but I love trading them. Corn, orange juice, gold, silver, you name it. And so, but in the last year or so, bonds have just been very conducive to technical analysis, at least my style. And we've done way more hits than misses on these, and caught most of the big major inflection points on there, and also been able to use them very effectively as a hedge to index longs, stock market longs and shorts. But here's where I think things are probably going. I've had these lines here for a while now, created back in May, you can see, of 2024, this orange line where I see this scenario. I recognized and completely expected a peak in interest rates there because of that big negative divergence. Again, I had that drawn there, and a beautiful uptrend line, and we had that. We broke down, went down. However, more recently, we broke this. And all along, I've been leaning towards this because when I say everybody, I'm speaking obviously generically, metaphorically, everybody but me. Most people think because the Fed started easing again that rates were going to go back down, and that's it. And that's all we're going to see for interest rates. But I'm very open to this scenario that is a divergence line. These are divergence lines that I've caught here. And by this trend indicator, by all metrics, we're above. This PPO above my 1.55 line denotes a bullish trend in rates. This is a great trend indicator. I look at the PPO, and quite often the zero line will delineate bull and bear trends, but every security is different. I talk about that a lot, so I analyze it, and I look at the white line, the 9 EMA on the histogram, and then I'll set that line, so I make an adjustment. There's a zero line. I have the line at 1.55. When you're below it, it acts as resistance. So when you have rallies back to it, you often get rejected. But when you take it out, that's bullish, and you are in a bull trend. And that was a bull trend that lasted over a year and a half. Remember, we're looking at a monthly chart. These are years here, not days or weeks. And this was a bearish trend right here, and you wanted to be short treasuries. We had a primary trend change there. And again, we're well above that. PPO appears to be coiling up. It hasn't crossed yet. So let me just tell you, I'm not betting this right now. I have no stake in treasuries at this moment. I'll let you know. I throw them out there all the time and tell you what I'm doing. But I'm very, very much open to this, mostly because very few think it possible right now. And that is, we take out the previous highs and we put a new high in treasuries, and we'll get a pullback, but we're going to get a nice rally until then. And again, it goes in fundamental analysis, factors into this technical analysis, a lot of it. Again, it's not something at this very moment I'm betting on, but it does help formulate my where are we going bigger picture. And for those of you thinking that, how, Randy, you're calling for a 50% drop in the stock market by the end of this year or next, how's that going to happen? Well, mark my words, and started back to that zones I gave you. We do this, we're going to be in the red zone. The red zone, pretty much all that we have to do is take out. My red zone is defined in TLT, in the 10-year bond, which means you spike above here, you're going to be in that red zone. And all hell is going to break loose if we start making a new multi-year high and take out that high in treasuries. It'll be everywhere on the headlines and the media, and Fed's lost control and blah, blah, blah. And then remember the beauty of this. If things play out the way that they have been shaping up for the last couple of years, the beauty of this is the Fed, for the first time in decades, again, has lost control of the long end of the curve. So they'll be powerless. Because if this happens for the same reasons that I went over yesterday in the CPI and the DJP, the commodity index, that inflationary forces are now here to stay, that the Fed got too reckless for too long, figuring that old economics 101, print too much money, keep rates too low, you're going to spur inflation. And now they let the genie out of the bottle. So let's just assume that's the case. And it is a fulfilling prophecy, and it starts a snowball. That'll be the technical catalyst. And the Fed then, as much as they would want to, you'll have Trump screaming. He'll be going from orange in the face, as he is now, to red in the face, screaming at Powell or whoever, if he cans Powell, to cut rates. But and again, we're not going to get too much into politics, but I don't think Trump understands the workings of this. He'll be clamoring for the Fed to cut rates, but the Fed will know that if they cut rates in an inflationary environment, it's only going to make matters worse. It's only going to further exacerbate inflation. And so, and they know that now, and that's why they're on hold. They're not denying that. So again, this is the situation will be the Fed will be pretty much powerless, and they'll pull all kinds of shenanigans. The Treasury will as well try to manage this. But all right, I'm spending too much time on a potential long-term scenario. But again, it is one to watch, and we'll talk about it there. And if you want to watch it more closely and you want to, act on it, via your 401k, your bond holdings there, your equity holdings, this has been a very accurate guide. And just watch this. We are now back down in the middle of the orange zone, and the market has rallied this morning. This is, in my opinion, right now a golden time. If I mentioned on the QQQ, I've highlighted since last Friday, several shorting ops, including on Monday right here on this pushback to the deep seek gap. I give it to you on NQ as well as QQQ. There's the downtrend line. So if you didn't want to short here the other day or here, right now it's a beautiful kickback rally to resistance. You can see this is my 60-minute chart of QQQ, almost a gap backfill right there. And if IEF, instead of being right here, smack down back in the middle of the orange zone, was up here, I would actually be more concerned about or more interested in either covering any shorts that I have right now or going long, expecting a breakout above the downtrend line. And then, as I've talked about recently, we start taking out these previous reaction highs, or my green level, we're probably going to see new highs in the stock market. But that's not the case. And so it is what the 10-year bond is doing that tells me this dip buy, or the dip buyer stepping in today, that's a golden opportunity. And I'm going to actually stop the video. I added to some shorts this morning as we started to bounce. I'm going to add to some more right now. Okay. All right. Quick rundown then of what else needs to happen. Again, bonds are a lot, but they're not everything. The things that are more, Apple we already had multiple sell signals here. Big one here on that trend line break. I'm on a 60-minute chart. We'll just stick to the 60s. Hit that beautiful 219, nice support level there. Bounced as expected. Also had positive divergence there with the RSI, and a perfect back test as highlighted at the time with negative divergence. Very objective short entry or add-on. And then just waiting, as I covered in recent videos, for break of this minor uptrend line. And then even better when we break I'm going to round that off. It's too close. It's 218.97 it says. So let's make it an even 219. Let's color it up. We'll make it yellow, meaning it's important level. Boom. Those are your levels you want to see Apple break. Otherwise, if it can go up here, and if it takes back that trend line, that's nothing but bullish right there, at least for Apple. NVIDIA, as mentioned yesterday in the video, I told you before, and then after it happened, there's an objective short. I said we were above this trend line. I said the next sell signal in NVIDIA will be a break below that trend line. Then towards the end of the video, we broke it. Told you could short NVIDIA. It's down, nothing big, but it's certainly a clean sell signal. Nice, well-defined uptrend line. And remember, that comes on the heels of this. And as per my prediction in yesterday's video, NVIDIA will most likely close the week. It's been back testing testing the 200-day moving averages, and so I want to ideally see it this week close back. Well, what I want to see is a solid red close, a weekly close, end of day Friday, well below those 200-day moving averages, again on a weekly chart. But getting again more granular, you had a short entry highlighted yesterday. That's simple. Short it there. There's your uptrend line. Stops are going to be commensurate to where you think it's going. I still have these long-term targets I gave you last year, which I completely maintain. This is still my final target, T4 down around $40. Remember, we hit T1, bounced as expected. We covered it there, reversed. And it's just the first leg down, leg up. Next leg down should take us there, and then there. So again, that none of this is going to happen until the 200s go. But based on the technical posture, I think there's a good chance they will go. What are the other big things doing? Microsoft, I've covered quite a bit, just hugging the 200-day moving averages for months now, starting to get below them pretty good there. This is a weekly chart. There's a daily chart. It's not the one I want. This one right here. So again, it's only going to go so far below its 200s until the rest of the lot start to crack their 200s. I'm talking about the Mag 7, but a little reaction low right there. So if Microsoft can just get a little more downside and it starts to get away from the 200s, then that gives me a pretty good check mark for Microsoft. Amazon, again, these were all covered yesterday, I believe. Sell signal triggered now. Let's see how we close the day. The day is too young to say with confidence, but as of now, we're below that trend line. Again, that's the primary trend line off the August 5th low of 2024. And we're below it there on the daily chart, 60-minute chart, really right about on it. So I'm going to take this line. I'm going to borrow this or move it right here. So this will do the trick. Set a price alert 228, below 228 Amazon should be done, and you could short it. Divergent high, already had bearish rising wedge breakdown, but this is your primary trend line, the one I just showed you on the daily. And so to be safe, wait for a break at 228, and then your first target's going to be about 216, and then it's going to, and then we'll look at the longer term charts. The 200 days are way down here. You got a lot of thin air between, or I should say hot air, between current prices and the 200s on Amazon. Alphabet continues to move lower post earnings. Still, it's on support right now. So again, these are levels. We want to see the support taken out. You can see it on my 60-minute chart. It's about 182.30. Previous reaction highs, two of them right there. Previous reaction low once we broke above it. And that needs to go to open the door to more selling there. Meta has been defying gravity. Got to give it points, but usually the last every time I've ever seen a top in the market, again assuming that's what's coming up soon, the last holdouts, there's always one of them. It's often Apple, could be sometimes it's Microsoft. It'll play a game of catch up to the downside. So I'll bet you options are dirt cheap right now. Put options on Meta. I'm not a big options guy, but everybody, when you get a stock like this, everybody thinks it's never going to go down. So if the next sell signals trigger that I just highlighted, I don't see Meta blinking until it drops 12% down to this level here, this intersecting up to trend line in 634. So it should be a pretty good ride down there. Again, but need to see some of those other things break. I'll put a BOD trend line because you have a little reaction low right here. It may come in, hiccup on this trend line, and then go. Tesla, like I said, hit that first target I gave you back in December here after this breakdown. But this one has, by the skin of its teeth, by the way, positive divergence here. You have equal lows on the indicators on the RSI and the PPO with lower lows in price and a downtrend line. So it gives you a bullish falling wedge. So if it can pop that, then it could run. However, if it goes much lower, it's going to take the divergence out, and it's probably just going to continue down to T2. And that's about it, guys. Levels to watch are obviously that 6017 level on ES, the S&P 500 futures. I'll give you the comparable levels on SPY in just 1 second here. And then on the NASDAQ 100, NQ, same levels that been on my charts. 1, 2. This one, you can see we're higher than the previous low there on NQ. So that really should open the door when we take out 21,382. And if we're looking at QQQ, which I think I just covered for you, on my 60-minute chart, 519.43, break of that should do the trick. And then on S&P 500, even if you're only trading one or the other, you want to see them both break support. Yeah, I'd still say this level here, about 595.71. Either way, we're, it's just, remember, we're still in this trading range. like I said, I'm getting a little excited because Treasury bonds are back into the orange zone, and I think and we've got yet another rejection on the downtrend line on Nasdaq 100. But it's still anybody's game. I mean, if they come in and step up and they buy treasuries and they get us back out of the orange zone into the yellow zone, we could pop and go to that new high scenario, like I say, and I still have a very high degree of confidence that any new high, and again, I'm really focused on the NASDAQ 100, that any new high will still just simply be a marginal new high that'll fail. But I don't, again, I give you the analogy between today and the last few months and late 2021, and just like then, we had the potential to pop. We were within spitting distance of the previous high and never made it. And then the market did that. So it's to just put this, summarize this, very simple. I give you the color by numbers or trade by colors, whatever you want to call it, on Treasury bonds on the 10-year on IEF. And I've been giving you the same thing here on QQQ. You can consider it noise if you want within the trading range until you break out. Now it's noise that if you get granular enough and you look at the 5-15 minute charts, you trade intertwined treasuries with it, you can successfully trade it and make some money on doing it. But again, if you're a long-term swinger trend trader, this is, I believe, will determine whichever way this thing breaks the next tradable trend. In the upside, as I said, might be no more than 8% tops, probably more like 3, 4, 5 if we break above the green level 534. Still favoring this for the reasons I mentioned, including today. Break down below 500 should open the door for a much bigger drop and increase the odds. We're going to take out the 200-day moving averages on the big market leading stocks, as well as the NASDAQ 100 itself, of course, and the S&P 500, of course. You need to take those out, and then that would open the door to the longer term targets. Until then, this is the market we have. So you either embrace and trade this or recognize it for what it is. And if it's not in your wheelhouse to actively trade a market like this, sit back, wait for your pitch. If you're a long-term swing and trend trader, those are the pitches I'd be waiting for. Break of those red or green levels. All right, guys, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.